Interest rates have improved nicely over the last week or so. How far will they go? Well, let's talk about it. Well, we did see nice improvement in the bond market over the last week. We're going to talk about some of the reasons why and where it might be headed. We've got other big news that hit today. We've got more potential news that's coming our way with non-farm payroll tomorrow. So there's a lot that can move the markets, but here's where we are today. Mortgage News Daily has the national average at 7.07%. Y'all, we were at 7.37% 1 week ago today, so we've moved a third of a point in a week. That is a nice improvement in rates in a short period of time. We were at 7.04 30 days ago in that same survey, so we are right back to where we were a month ago, y'all. So we had seen rates for the first 3 weeks of this month really just take off higher, hit 20-year highs. We talked about it on our previous two calls. Tried to strategize some around it, but we've seen some nice improvement this week. So here's the question: will it last? And what does this mean for the Fed moving forward with some of the news we got today and more news that we're expecting? Well, personal consumption expenditures came in this morning, and it came in as expected at 0.2% increase month over month. So when you look at the year over year comparison, July of last year, that was actually a negative number. And that was an outlier, y'all. I believe that was the only month of the year where PCE ran negative. There's a number of things that can cause that, but in any event, the year-over-year comparison makes it look as though PCE is not quite as good as it otherwise might be on the headline number. Don't pay attention to that headline number. It has us at 3.3% year-over-year inflation. That's only because it's comparing it with a really, really low outlier number for last year. The important part of this report is it came in at expectations of being up 0.2% month over month. That's what we're really looking at. So what does that mean for the Fed? Well, this is their favorite read on inflation, and it's showing that we're continuing to improve, y'all, on the inflation front. Adding to that mix, tomorrow we get non-farm payroll. If we see significant tightening in the labor markets, that's going to be an indication to the Fed that there's still tremendous underlying strength in the economy and that we may still have some burbling inflation yet to come that they need to combat. The reverse is also true. If we come in at expectations or a little bit better, a little bit worse than expectations, to the extent where we're seeing some softening in the labor markets, well, then the Fed may take the opposite stance. Here's one of the reasons why some folks are expecting that. Number one, we've had really strong employment reports the last several months. The majority of the reports over the last 6 months have beat expectations, right? So we may be due for a report that does a bit of a correction in that. Secondly, when you look at a number of speeches that voting Fed members have made over the last week, you have several of them that have given some fairly high profile speeches where they are suggesting the Fed should pause. We haven't seen much of that during this cycle. Most of them have been quite hawkish with regard to where the Fed should be. So what should we do going into the report tomorrow? I would take whatever improvements we've seen this week. If you have loans to lock today, if you're a real estate agent and you're advising a buyer that's just gone under contract today and they've not yet locked in their interest rate, today might be a good day to do that. Because we've seen some improvement over the last week, I would go ahead and grab it. It's a bit unexpected that we saw this nice improvement this week. There's no reason to float going into tomorrow's report because a stronger than expected report could take us right back to where we were last week, y'all, with regard to interest rates. One thing I want to continue to state on each of these calls going forward for at least the foreseeable future, and that is what I mentioned on the call last week, and I said it several times, that folks should marry the house and date the mortgage. Even though we are seeing tight inventories currently, they're not as tight as they're going to be when interest rates do make significant movements downward, as we're all expecting them to over the next year, year and a half, 2 years. Plan on refinancing anything that you write paper on today. Try and get as cheaply into the house as you can today from a cash standpoint, and then bank on refinancing that a year, year and a half, 2 years down the road when rates improve, as we're all expecting them to. Here's the thing that a lot of folks don't realize on a refi: 99% of them close with no cash out of pocket at closing. We see the majority of our refis choose to roll in closing costs into the new loan amount so that they're not actually bringing any of that cash to closing. Remember that every $1,000 you put down on a mortgage reduces your payment a little over $6, right? It's not a dramatic difference. So if you roll in some closing costs into the new loan, it's a pittance to your monthly payment. but it can make a significant difference to what you have in the bank in your depth of pocket. And for a lot of folks, that's more important, especially as rates improve for that refinance. So in any event, something to keep in mind, don't plan on having to bring a ton of cash for your refi, if any at all, because again, the majority of them close with no cash due at closing or very little. In any event, I hope this is helpful for you and for your clients, trying to reset expectations, y'all, so that we can move some inventory now and then put those folks in a more attractive position when the market does churn and we see interest rates significantly lower. In any event, hope this is helpful for you and for your clients. You've got all my information on the screen. Always honored to have your referrals. It's why we provide this information. Send us some business. I think you're going to be very impressed with the work that we do here. In any event, stay blessed, stay safe. We will talk to you next week.